That's right, Nancy. At Eastspring, we like to ground our analysis in valuation. And if you look at valuations of equities across the world, if you look at bonds relative to bonds, equities look far more attractive than bonds. And the equities in Asia, in fact, are the cheapest in the world, cheaper than the U.S., cheaper than other regional markets. So that gives us confidence that we're at a good entry point, that when markets sell off indiscriminately like they have this year, it's actually a good time to buy.
Some may say, though, there's a reason they look cheap. People are worried about the impact of this trade fight, what it will mean for, let's say, what the PBOC has to do. They are quite focused on deleveraging, but now you have this issue of, ooh, how much of this can we push through when we also have to offset some of the weakness we might see in the economy as a result of these trade tensions. Is that a problem?
That is. I mean, there's certainly a lot going on. There's a lot in the mix. I think a lot of the things that we're worried about today with regards to China deleveraging, the world has been begging China to go through the hard yards of deleveraging and clean up its act and have better quality growth, not just strive for the highest possible growth, but to have better quality growth. And so the deleveraging process, yes, is short-term pain for long-term gain. So we're not so worried about that. We've got the trade war concerns, which are indeed valid. That's happening as we speak. So I think that's probably a more important and real issue right now, because we don't know how that's going to play out. But again, it's more of a temporary. This shall pass. It's not a structural change in the market.
And until we get to that moment where it does seem to pass, who do you think has the greater pain tolerance to really lessen the blow coming from these trade tensions? Because many will say, look, the Chinese government has more at its disposal when it comes to what it can do to kind of lessen the blow. Is that fair?
I think that's completely fair. I think that China, the way the government is set up, it has more firepower, in fact, to battle this, and certainly is not going to just sit back and take it. So I think we're very confident on China. We find good businesses in China, and regardless of what's going on in the markets, with all the volatility, there's still plenty of great investment opportunities in China.
Do you still like the Chinese banks?
We do. We still like the Chinese banks, but we're very careful about what we own. We make sure to buy the large, liquid, well-funded banks that are net lenders to the interbank market, so that aren't relying on external funding. So strong franchise banks, in fact, not weaker banks in the system.
Looking outside of China, what other areas of the Asian market do you like?
So given the volatile outlook, we're very much focused on finding investments for our clients that are less volatile, that are in markets like Thailand, in markets like Malaysia, in markets like Singapore, that typically are less volatile than your Korea, Taiwan type markets that tend to wobble a bit more. Even though long term we have a favorable outlook, those markets tend to have bigger swings.
Do you worry about Singapore's vulnerability, though, to the trade flows?
I mean, we were looking at the data. I mean, U.S. revenue of Singapore companies is only 2%. So I think we're fairly unconcerned about Singapore in the broad scheme of things.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.